Good morning, everybody. Welcome to the Flow Show. Here we are, NFP week. Going to be another big one, playing the 25-50 pip cut game. We'll see what that data brings later in the week, but plenty more to get through before we get to that point. I hope you're doing well. Hope you all had a good weekend. Not too rainy for you like it was here in the south of England. Absolutely torrential for most of the weekend. Good for weather for ducks, as we like to say. Right, let's get on with stuff. The PBOC last week, Friday afternoon, cut their SLF rate, 20 pips, part of their moves that they've been making in easing, so it was expected. They've announced that the 50 pip cut to mortgage loans, existing mortgage loans, will be done by the end of October. We did get some data out from China over the weekend. We got PMI data from those guys, if I can find it. There we go. So both sets, both the state numbers and the Caixin Bank numbers there. An improvement on manufacturing from the state numbers to 49.8 puts it 2 pips shy of that magic expansion level. Services, though, softened right bang onto that expansion level at 50, coming in lower than 50.3 previously and 50.4 expected. The Caixin number went the other way for manufacturing. It moved into contraction from expansion. Services softened there as well. Obviously, you're not going to see rate cuts, if they are going to have effect, and all this easing coming through in that quickly, considering these numbers were taken a couple of weeks ago. But they will want to see these numbers turning around in probably the latter part of this year, going into next year at the very least. So they want to see some action for their easing, shall we say, going into the next few weeks. But at the moment, those numbers continue to show weakening economy over there in China. Over in Japan, we had some data out as well this morning. I'm going to go back up there. Industrial production not looking all that great, coming in month on month down 3.3%. Was only expected to pull back 0.5%. Year on year, the numbers look a bit stinkier as well, which are not on there, are they? No, they're not. That came in at minus 4.9% from minus 1.5 expected. Prior was up 2.9%. Retail sales, that did look a touch better, beating expectations for the year-on-year number there. Large retail sales coming in a nice 5% there too. Month on month, they were up 0.8% versus 0.5 expected. So a decent showing from those numbers as well. We've had more out from the new PM Ishida, saying he will deploy fiscal stimulus if needed, and already talking about some measures to help the burden of consumers from higher prices. He also reiterated there's no change to the Bank of Japan's accommodative monetary policy trends. Now, this caught dollar yen on the hop last week when he said that. It's not him saying that he wants them to be accommodative. He's saying that they should remain accommodative even while they're hiking, so i.e. not to go too fast on hikes. But then he said he won't make any request on the Bank of Japan on monetary policy. He values their independence. He has set forward a date for a general election of October the 27th, so the end of this month. They will dissolve Parliament on the 9th of October. Now, this isn't like other countries where, you know, there's general elections every so often and whatever period, like 5 years for the UK and 4 years for the US. They can call elections as and when they see fit, and a lot of leaders or new PMs, new guys who take over the party, tend to call a general election. It just cements their stance in government for a few years. It's almost become like a ratification process. but more just a formality, just to say, yeah, we've got a new guy, and now we make it all above board that the people vote for him as well. He started off on the front foot. A survey out in the main Ichi poll says that optimism for the new PM is at 52%. Kishida's popularity, I think, was trending down in the low 30s by the time he decided to quit. So it looks like Ishiba is starting to say on a bit of a front foot, a bit higher in the popularity stakes. Data from the UK this morning, we got final GDP numbers, which came in a point soft at 0.5%. Also missed expectations on the year-on-year number, 0.7%, although it was higher than 0.3% previously. Mortgage data in from the UK as well, that came in a bit more positive. See, where is it? There we go. Mortgage approvals, just under 65,000 there, beating expectations 64,000, higher than upwardly revised 62.5. So no signs that the UK has been struggling yet, or the housing market, mortgage market has been struggling from those higher rates, not really been biting too much, and our rates are set to come down. We should see a bit of a boost coming in. Obviously, this is August data, so a bit lagging behind, but we should maybe start to see that improve as well. We also got some Bank of England consumer credit data, which was at a small upside, but nothing to write home about. I did look at the numbers as always. Credit card usage was still pretty low, 500 million unchanged. So there's nothing untoward in that in terms of people finding finances tough, so using the plastic to pay for stuff. So move along data from that. Germany, they were out with their regional CPI numbers, all coming in softer year on year. As you can see down the list, Baden, Württemberg, Bavaria, Brandenburg, Hesse, North Rhine, Saxony, all coming in lower and lower. We have had people in Germany touting that there may be a bit of a bounce in inflation into the latter part of the year, just base effect stuff. Also, I think ECB's de Guindos also tipped the nod to seeing that, but we're not seeing that anywhere at the moment. We've had France and Spain last week with some pretty soft numbers. Germany now also much softer. Italy as well, CPI. Look at that. It's not even got a one handle on it anymore. 0.7% for their CPI, 0.8% for their Eurozone measure. So well below ECB's target. We do have the flash numbers for the Eurozone coming up soon. They're expected to dip a little bit, but I think the market's going to be looking for a bit more after seeing some of these numbers. I think it's tomorrow, but I'll look at that in a moment. New Spanish or Bank of Spain governor and ECB member Escriva says that the economic outlook is worsening. Germany taking note of that because apparently, according to a piece today, they are going to forget about economic forecasts for this year. They don't see any growth coming this year. So we're going to be expecting them to maybe change their forecast to a flat reading, if not maybe a bit of a negative. So they're getting rid of their growth forecast for this year on the back of that. Back to last week, the US data. It was PCE day, and the market had a bit of a reaction to it. These numbers really didn't come any different to what we saw from the CPI data 2 weeks prior to this. Headline PCE dropping 3 pips, a bit softer than expected, admittedly. But the core number stayed unchanged, or matched expectations, actually went up a pip on the month before. So if you remember, the core CPI numbers stayed unchanged. I think it was 3.2%, where these ones went up a bit. So similar in moves, but the market got a little bit more dovish. The Fed, as is wont to do, playing the old 25-50 game again on those softer numbers, softer monthly numbers as well. We got the Michigan data out as well later on, and there was a bit of improvement on that. The headline number ticking up to 70.1. The inflation numbers largely unchanged at over the flash numbers, and prior numbers 2.73.1. So maybe still looking a bit sticky in the inflation expectation numbers anyway. Canada GDP data, we know that Governor Macklem would like to see growth trending over 2%. He's not quite there. Year-on-year number, which is not produced there, came in at 1.5% versus 1.3% previously. But the July GDP coming in at 0.2, and they gave a flash for August, which is coming in flat. We'll see how that gets revised a bit later. Fed's Bowman says that data is pointing to continued economic strength. She was the dissenter at the last Fed meeting. I believe she's speaking today, and Powell's up too at some point. Fed's Muslim says he sees more than one additional 25 pip cut for the rest of 2024. So he's looking for 2 cuts, if you follow his maths. All the banks, as we know, have been ramping up their expectations for the ECB. Goldies now expect the ECB to cut rates in October, alongside JP Morgan, seeing them cutting every meeting from October. Barclays similar, October cut, and future cuts as well through next year. BNP also joining the Oct bandwagon. So everyone's getting around this October data, and the fact that the ECB are maybe going to cut again, which hasn't really gone along with what some of the ECB talking heads have said, pointing to December, but obviously with a caveat that if the data declines, then they can look at rate cuts any time. But we've got a higher pricing for October now than we've had 2 weeks ago, or since the ECB meeting. So we know which way the balance of risks is leaning now. It's if they don't cut, the market will get a bit disappointed about that. Right, I'm going to have a quick look at what data's coming up this week. It's a bit of an odd week this week. Usually it's really busy, but we've got a fair amount of data out. Obviously had the German regional numbers. We get the headline number coming up at 1 o'clock today. That's UK London time. Tomorrow it's PMI day. We get all the final numbers and some of the fresh numbers for the manufacturing PMIs around the grounds. There's that Eurozone flash CPI number. As mentioned, probably should be looking at a bit lower than what's expected, but I'll check on that tomorrow to see what we are expecting. Then we get the final US PMI and then the ISM manufacturing number later on. So that will be closely watched, obviously, to see if there's going to be an improvement there. Still in contraction over there. Now, the market may get a little bit excited because, again, this data won't have any time to react to Fed rate cuts. So if it is a soft one, then we're going to see the market obviously running towards that 50 basis point cut, and maybe risk trades as well, seeing a little bit of a dip on that hopium trade that we've had all last week. After that, we get jolts, which was a bit of a wobbler last month, dropping into the 7 millions from the 8 millions. So if we get another big drop there, that's going to play into the labour market weakness theme. Again, that will affect the Fed rate cut expectations. And on Wednesday, we get ADP. That's probably the main number to keep an eye on, the appetizer for the NFP. Expecting a rise from the 99, I think it was 99 last month. Expected around 124. Let me just click on that just to make sure I know what I'm talking about. 121.5, 124 on some other calendars from the prior 99. So a bit of an improvement expected there from the ADP data. Nothing else of note on Wednesday. Thursday, we get all the services PMI finals and some first numbers from the likes of Spain, etc. That all culminates through to the ISM services data, which will be sort of our last number to trade around ahead of the NFP and get the last minute Fed expectation trading going on there. Keep an eye on this Challenger job cuts report. Well, I will anyway. I don't know if you will, but I'll be watching it. Last month's number or data from those guys said that hiring was at the lowest since they started the survey in 2005. So a lot of people slowing down on hiring. So we'll see if that's going to continue, maybe even turning into job losses. I think we're walking a bit of a tightrope at the moment between slowing hiring and when that tips into, firing, shall we say, rather than hiring, because that is a negative slant. While we're still slowing hiring, it means there is still hiring, and it keeps the soft landing tone in play and the strong jobs market. But if we do start seeing firing, that's a different kettle of fish altogether. Obviously, jobless claims, that won't have too much of a say unless we do see a wobbly number, because obviously this is more update than we will be getting from the NFP. But as the last few months and years have shown us, there's nothing really going on there to worry us. And then on Friday, it's all about the NFP, and it's not a double bubble with the Canadian jobs. That'll be next week. So it's all about the US and what that brings. So no, don't worry. I'll be getting the NFP competition up and running sometime this week, and you can all have a crack at that. So that's what's coming up on the data front anyway. Now we have a little butchers at what's going on around some of the markets. Dollar yen's been on a bit of a wobble. It got down to a zone I was keeping an eye on down here. It's sort of the bit of a last line in the sand for my longs. So I've been, it hasn't been really working, but I'm sticking to my plan because I've been going small and spreading it wide. But this is really, as I say, a bit of a line in the sand for me. If we're getting under 141.70s, this area here, that little low there, then I'm probably going to chuck myself out the trade. Because I was thinking we might be seeing a bit more of a bounce, particularly on the back of US yields rising. And it went a bit wobbly last week. We had yields, ticking back down towards off this high, ticking back down again, but they're coming back a little bit again this morning. So it looks like we may have found a bit of a bottom into 350. I'm not expecting these to shoot meaningfully higher, but they could move around with data points if obviously they're good or bad. The same with tens. They had a little wobble late last week, undoing the move up to these highs on Friday. But then again, we are still just maintaining this uptrend. But those yields, if they get it back above 379, 380s, they could creep up again. But again, I'm not expecting any massive jump in yields. We know that the Fed are cutting and they're going to continue cutting unless the data turns super duper hot and we get some super hot inflation numbers as well. So, but this is part of a bit of a bounce off of this area. So maybe 385s, 390s, probably tops before we maybe see a bit of a top forming in those yields there. And if that carries on going that way, then that's potentially going to help my dollar yen position. But yeah, I may, if I get above break even on my average, I may start re-inking my stop up just to reduce my risk as we go along. Euro dollar, as it's looking like at the moment, as James also mentioned in our chat room, looks like we may have some last minute in the month stuff going through as well. We've seen another little go at 112, did poke its nose above by 9 pips, but it's pulled back under the figure. I've actually pulled my buy stops that I'm running at 112.15 because I don't want to get messed around with any last minute end of month stuff. A bit like other trades, I'd rather levels break under their own steam rather than under the influence of temporary factors like end of month. If we do get a break and it's today and it's still going, then if anything, I'll just wait to see if we get a confirmation move back down to 112, and if that holds, that that may give me an opportunity to jump into further longs. I'm still running my longs from 110 anyway, so it wouldn't be a disaster if I didn't get a trade up here. I'll just keep running that position and slicing and dicing, but still a bit of a tough nut, this 112, and it's not quite ready to break through yet, which the more times it happens, it'll either go two ways. Either the more times we get tests and holds, it'll either break. Sorry, I've got to turn my squawk off. Yeah, it can go two ways. We either get continued tests here where we're not dipping too far, and then eventually it's going to break and it will take off, or we're going to run out of time, and those who are long up here are going to lose patience that we're not getting through the level, and then you start to see a bit of a domino rally, and all those start to get out of trades. I don't think we'll see a much action unless we get down to 111. If we break through there, then we're probably going to get a bit of a it'll pick up a bit of speed, as I say, and then we might be heading down to 110 pretty quickly again. But yeah, it's still on the fence, this one here, so I'm just watching and waiting and see what it wants to do. How is China's stimulus supporting the euro? It's not supporting the euro, Ellie. What we're seeing from this China stimulus is it's supporting commodities and then by proxy commodity currencies. So you may say it's supporting euro dollar, but it hasn't, particularly last week, hadn't been supporting much of the crosses, as you can see here, particularly the commodity crosses. We have seen a couple bouncing back, like the Canadian dollar. That's a different kettle of fish altogether. But if you look particularly versus the Aussie and some of the others, the euro hasn't been supported. And the euro won't be supported. The euro-China stimulus is not a correlation I would look for, particularly. Look at it from a risk perspective, as I say, commodity perspective. This could all just be, as I say, in the month stuff. It's also a bit of dollar weakness in there as well. It's a little bit of yen going on, like we saw this dip in dollar yen this morning. That's been reflected in the crosses as well. Pretty much a lot of the crosses looking at saw this dip as well. So it's not just a euro trade. No one's piling into euro longs, I don't think, and because the euro's in a fine state. We know that from the GDP data, PMI data. We know that from falling inflation and a rate hike maybe coming in October. So when you see the fundamentals, or when you see the currency not aligning with the fundamentals, then it's something else that's driving markets. But it's not Chinese stimulus. Rav, yeah, already looked at dollar yen. The Nikkei, it's been a bit of a mix, this Nikkei. Obviously, you've had the new PM coming in. We've had some of that stinky data or worse data coming in this morning. The Bank of Japan, or the way he's been talking about the Bank of Japan, the market's got the wrong end of the stick a little bit in terms of what it means for the BOJ. It's still quite positive. There's obviously been a bit of follow through from Chinese stocks as well. But I think this is just a little bit of a shakeout on that softer data that we've seen this morning as well. While we're on talking about China, we'll have a look at that. That keeps ploughing on. Markets there keep ploughing on. I've seen a lot of people trying to put text to this one, where the next resistant points are and this and that and where it's going to go. I think the techs are out the window at the moment. When you've got a country telling all its financial institutions, we're going to give you loads of money to go and buy stocks, they're not going to worry about coloured lines, technical analysis, moving averages, RSI, and all the rest of it. If they're going to buy stocks, they'll keep buying it until such time as they've bought enough and that the stock market's not going down anymore. There's scope to see these continuing to go higher. I mean, that's not a normal move, but that just gives you an indication of the power of China if they want to go and start throwing some money at stuff. That's the sort of moves you're going to get. You don't see these in other markets, completely obviously manipulated. So until we see this sort of petering out, then it's still going to be good for the risk trade. We did see a bit of a move in copper, pretty much on the open. Let's come into a bit of a shorter time. I don't know what the spike was. I still haven't found out what that spike was. It might have been that first improvement in Chinese data. I'm not sure. It might just have been a bit of a blip at the open overnight. But anyway, copper's had a bit of had that spike up. That was through the 61.8 fib. What's interesting is that it couldn't get back above thereafter. So again, that just tells me that might have just been a bit of a suspicious move, and we're back down again now. So in terms of the risk trade, it looked like it was running into a bit of trouble in the latter part of last week, as we saw particularly on Friday. We had this. This is all China, Ali. If you want to know what China stimulus does, it does this for commodities. But we've had a little bit of a pullback. Currency-wise, Aussie dollar, that's probably been one of the strongest ones out the lot. I was saying last week where we closed would be important. We closed just above, I think 3 pips above 69 level on Friday, and it was just enough to give it a shove up this morning just to a new high by a few pips, and we've had a shallow pullback. So we know where the levels are now. 69 is your short-term close support level, then down into this zone again. And if we can keep this above 69, then we're going to be pushing on for that 70 level, I think. And that's really going to be the big one to keep an eye on. Let's go on this chart just so you can see that a bit clearer. Because the 70 level, it's just one of those old levels that always has a say in things when we visit it, particularly if we haven't been there for a while. So if we're going to run into a bit of stronger trouble, that's where I expect us to do so. We're probably going to get a bit of resistance, 69, 40s, 50s. We already got a high 41, so that's just a little bit of a traffic area that you can see on the shorter term charts, at least. Let's see if I can try and find that without zooming in and out and in and out and in and out. So just into this area around here, 50s, just a couple of little high points and resistance points and support points around there. So 40s, 50s where I expect the next bout of traffic to be. Otherwise, it really is all about that 70 area, and the resistance for that starts around 69.80. So if you plan this one alongside, then that's where you're going to be potentially thinking about maybe taking a bit more profit off as you get towards that 70 level, 69.80s, 85 area. What else? Let's have a quick look at oil. We've still got this stuff kicking off with Israel and Hezbollah, but oil not really taking much notice of that. Back down towards lows again. This rally petering out pretty quickly. Same in US, petered out just at the bottom of my zone. Haven't quite got down to that prior low, but this is again, it's another sticky area down here, another zone that I've got of support that has just been in play going back for a few years. So no surprise to see us pulling up there. The situation hasn't got any better over there in Israel, so it could still lead to wider conflict. Not that oil markets are paying much attention to it either, and obviously the passing of the storm in the US is taking a bit of premium out of that as well. So not much going on there. Gold, that's had a little bit of pullback as well. It's gone through this 50 area now. So we'll have to see how this one develops. Do I get rid of my line and see if the level is going to develop somewhere else? We are finding a bit of support just into the 43s. Maybe this line is going to become valid. I think what happens here though is we see this high area 70, 75. That's going to maybe solidify as resistance. So if we get another test up there and it holds, then maybe we're going to start developing something a bit more longer term like here, in terms of where we find a bit of a higher range to move through. But I think we still just need to find out where the real support point is. These are possibilities rather than levels that are going to be definitive. So could carve all the way through them, and then who knows where we're going. Might be going back down under 2600. This 26 is probably the main area you want to look at. 2590s, 26. If this is going to pull back a good chunk, then, you know, if I had to rate my levels, this is where I'll probably see the strongest support showing up into the figure 2590. So keep an eye on that one. But as I say, these are just possibilities, not definites for now. S&P is a bit similar as well. We had this former high 57.35s, and now we're just sort of walking along it, not sure whether to come under, stay above it, come under, stay above it. So I think that till such time as you get a resolution here, it's a bit hard to make a decision on which way it's going. It's still maintaining the uptrend, so that's still very positive, but this just looks like a bit more indecision now. We've had a little step down off the high. If we can't get above this high on a retest again, you've got then potentially 3 periods where we haven't managed to make a new high, which again, then you start to think about maybe there's going to be a bit more of a permanent top coming in, however long that permanent top lasts, be it a day, a week, or whatever. But I think if we do get under this 35 level and find it as resistance, then this is probably going to be a decent level to lean against for shorts. And then obviously down here into this confirmed zone is where we'll find the main support for now. So yeah, a little bit of picture development to keep an eye on, and obviously the data this week is going to be a big driver behind all that. Right, unless you guys have got anything else. Oh, Ali, what are you doing now? You're going to have a long on dollar Swiss. Oh yeah, I was looking at this one earlier. Where are we? Oh, because it was tapping the 84 level when I had a look this morning. We were down close to that again this morning. I don't know. I'm nearly close to maybe thinking about having a long down there. Might have missed it already. Doesn't matter. I am potentially being a bit more greedy and waiting to see if we get a move down to that prior low and the 83 level. But what might be happening is, because we've got this range going in, if we do break below 84, we could be there pretty quickly and maybe even heading lower. We certainly can't seem to get through this 85s, 50 area. So if you're trying to long down there, where are you looking to go long, Ali? Let us know. Euro sterling, still not doing an awful lot. Bounce isn't overly strong again. I don't know. I'm not in a mood to trade this at the moment unless we see something rally up to maybe sort of 84s, something like that, or 83.80s again. Could be we're just going to do one of these again, and one of those, where we just have a little bit of a consolidation, a little bit of an up move off the lows. But it's there to be defined again. You know, if we can't get up to this high, then we're going to set lower highs, and then we've just had a lower low. So maybe we do continue dribbling lower. I'm still not looking to trade this unless we get a move down to some of these more lower levels, 82.76, and particularly the big old 82 number. Right, if you guys and girls haven't got anything else to for me to waffle on about, then we'll call that a session. Ease us in nice and slowly for the week. So have a good one, everybody. Take care. Have a good trading week. Don't do anything silly. Be safe. We'll catch you all tomorrow. Have a good one.